Have you ever noticed how buying a car has become less about transportation and more about proving that your life is moving forward? A new job, a promotion, a higher salary. Almost immediately, the next conversation becomes, "So, are you getting a new car?" For millions of people across the United States and Europe, this question quietly starts one of the biggest financial commitments of their adult lives. Yet very few people stop to ask something much more important. Is buying, leasing, or financing a new car actually the smartest financial decision? Let's look at a story that might feel surprisingly familiar. Meet Daniel. He's 29 years old and lives outside Chicago. He earns around $70,000 a year. After taxes and deductions, he takes home roughly $4,400 each month. His monthly expenses are fairly normal. Rent takes about $1,600. Utilities and internet add another $250. Groceries cost around $450. Student loan payments are $300. His credit card payment averages $200. Insurance, subscriptions, and other everyday expenses consume another $500. Before transportation, Daniel has already committed about $3,300 every month. That leaves him with roughly $1,100. Then his 10-year-old sedan starts becoming unreliable. The repair bills arrive more often. The air conditioning barely works. Friends joke that it's time for an upgrade. One Saturday afternoon, Daniel visits a dealership just to look. Within 2 hours, he's sitting inside a brand new SUV. The salesperson isn't asking whether he can afford the entire vehicle. Instead, every conversation revolves around one number: the monthly payment. $549 per month. It includes the warranty. You deserve something reliable. It's only a little more than your phone bill and streaming services combined. Daniel signs the paperwork. Driving home feels incredible. The new car smell. The touchscreen. The quiet cabin. For the first few weeks, every drive feels like a reward for years of hard work. But something subtle begins to happen. The monthly payment arrives. Insurance is higher than expected. Fuel costs increase because the SUV is larger than his previous car. Annual registration costs more. The excitement slowly fades. The payments don't. This is one of the oldest financial tricks in modern consumer culture. Not because dealerships are evil. Not because banks are dishonest. But because our brains naturally focus on monthly affordability instead of total cost. Suppose Daniel financed a $42,000 SUV over 6 years at around 7% interest. His payment looks manageable. Around $700 each month, depending on the loan terms. But over those 6 years, he doesn't simply pay $42,000. He ends up paying thousands more in interest. Meanwhile, something else is happening that receives far less attention. The car itself is losing value almost every day. A new vehicle commonly loses a significant portion of its value during the first few years of ownership. That means Daniel is paying interest on an asset that's becoming less valuable over time. Imagine buying a smartphone for $1,000. Every month it becomes older. New models arrive. Its resale value falls. Now imagine borrowing money to buy that phone and paying interest while it depreciates. It suddenly sounds much less attractive. Cars work in a very similar way. Now let's consider leasing. Many advertisements make leasing sound like the perfect compromise. Lower monthly payments. A new vehicle every few years. Minimal maintenance worries. Always driving the latest model. For someone who values convenience, it can sound almost ideal. And in some situations, leasing genuinely makes sense. If you drive predictable mileage, enjoy replacing vehicles regularly, or need a reliable car for business purposes, leasing can fit your lifestyle. But most people don't compare leasing against buying. They compare leasing against their emotions. The lower monthly payment creates the feeling that the vehicle is more affordable. Yet after 3 years, the lease ends. The payments stop. But so does your ownership. You return the car. Then the cycle begins again. another contract, another payment, another 3 years. Financially, it's similar to renting a very expensive appliance. You enjoy using it, but you rarely build ownership. Now let's return to financing. Financing often receives criticism, but it's important to separate the tool from the decision. A loan itself isn't automatically bad. If someone buys a reasonably priced vehicle, keeps it for 10 or even 15 years, secures a competitive interest rate, and avoids stretching beyond their income, financing can be perfectly rational. The problem isn't financing. The problem is financing far more car than your financial life actually requires. That's where psychology quietly takes over. Human beings are remarkably good at adapting. The first week with a luxury interior feels exciting. After 6 months, it feels normal. What once felt extraordinary quickly becomes ordinary. But the financial commitment stays exactly the same. This creates a strange imbalance. The emotional reward keeps shrinking. The monthly payment never does. There's another psychological force at work as well. Cars are highly visible purchases. Few people notice your retirement account. Nobody compliments your emergency fund. No one stops you in a parking lot to admire your low-cost index fund. But people immediately notice a new car. Humans naturally respond to social signals. Owning a nicer vehicle can feel like visible proof that we are succeeding. The irony is that many financially secure people don't think this way. They often ask a completely different question. Instead of asking, "What monthly payment can I manage?" they ask, "How much of my future income am I willing to exchange for transportation?" Those questions sound similar. They're actually worlds apart. Let's compare two different paths. Daniel finances the new SUV. His friend Emma keeps driving her reliable used sedan for another 5 years. Instead of paying a large monthly car payment, she invests roughly $600 every month into a diversified investment portfolio. Assuming a long-term average annual return of around 7%, after 5 years Emma has invested more than $36,000. With investment growth, her portfolio could be worth well over $40,000. Daniel also spent roughly the same amount of money, but much of it disappeared into depreciation and interest. Neither person made a dramatic financial decision. Neither won the lottery. Neither started an extraordinary business. They simply directed the same monthly cash flow toward different destinations. One bought a rapidly depreciating asset. The other bought productive assets that have the potential to grow. That's the quiet difference. Financial intelligence often isn't about making spectacular choices. It's about recognizing opportunity cost. Every dollar has only one job. It can improve today's lifestyle, or it can improve tomorrow's freedom. Sometimes those goals align. Often they compete. Does this mean nobody should ever buy a new car? Not at all. If you've built a healthy emergency fund, consistently invest for retirement, have manageable debt, and buying a new vehicle comfortably fits within your financial plan, then purchasing one may be completely reasonable. Money is meant to improve life. Reliable transportation has real value. Comfort has value. Safety features have value. Enjoyment has value. The important question is whether the purchase reflects your priorities or someone else's expectations. Too many people spend years paying for an image that only impressed strangers for a few seconds. The wealthiest decision isn't always driving the oldest car, nor is it driving the newest one. It's choosing the option that allows your transportation to support your financial life instead of quietly controlling it. The smartest financial decisions rarely feel exciting in the moment. They are often calm, intentional, almost boring. But years later, they're usually the decisions that provide the greatest freedom.